Hey everyone, welcome. Let's jump right in. Today's explainer is all about demystifying something we talk about constantly, but honestly often misunderstand: dividends. We're going to tear down this alluring myth of free money and look at the actual mathematical reality of total returns. By the end of this, you're going to have a crystal clear understanding of the machinery behind the payouts so you can make far smarter moves.
Okay, so let's dive into this. Picture this: you see a stock flashing this massive double-digit dividend yield. Your first thought is probably, whoa, I need to get in on that right now, right? It's totally natural. But is chasing that sky-high yield actually the smartest play? Or is it basically a siren song, pulling you into a trap? Well, we're going on a little myth versus reality journey to find out exactly what's lurking behind those flashy numbers.
Now, I know you guys follow this stuff, but let's briefly ground ourselves with the absolute basics, straight from the Munich Business School. Put simply, a dividend is just the slice of a company's net profit that it decides to hand back to you, the shareholder. It is your literal, tangible share of their financial success. Now, keep in mind the difference between regular dividends, which are your predictable, recurring payouts, and special dividends, which are basically one-time bonus checks. And hey, quick heads up for your tax planning. How long you hold the stock totally changes your tax bill. Qualified dividends get those nice lower capital gains rates, while non-qualified ones get taxed as regular, ordinary income.
All right, so here's our roadmap for the explainer. Number 1, dividend basics and dates. 2, yield versus payout ratio. 3, the dividend royalty. 4, the compounding power of DRIP. And 5, avoiding the yield trap.
Okay, moving right into Section 1, Dividend Basics and Dates.
Let's look at the chronological flow of a payout, because the timeline is everything here. It kicks off with the declaration date. That's when the board officially announces the dividend and sets the schedule. But listen, here is the absolutely critical deadline you've got to remember: the ex-dividend date. This is usually set 1 business day before the record date. If you buy the stock on or after this ex-dividend date, you get nothing. Zero. The seller gets the dividend. You literally have to buy before this date. Then, on the record date, the company checks its books to see who qualifies, and weeks later, the payment date rolls around and that sweet cash finally hits your account.
All right, time to bust that free money myth wide open. You know, on the morning of that ex-dividend date, the stock price technically drops by the exact amount of the dividend being paid. Why? Because the company has officially committed to parting with that cash. That value has literally left the corporate treasury. It's just a mechanical adjustment by the exchanges. You know, unlike a bond that pays a guaranteed coupon, a stock dividend is never mathematically guaranteed until that declaration date. So this price drop completely shatters the illusion that you can just, buy a stock the day before, grab the dividend, sell it the next day, and run off with free money. It doesn't work like that.
Let's move into Section 2, Yield versus Payout Ratio.
When you're sizing up a stock, you've got to look through 2 very different lenses. First up is the dividend yield. This is just the annual dividend divided by the current stock price. This is your view as an investor, your bang for your buck. But quick aside here, be super careful to distinguish between trailing yield, which just looks backward at past payouts, and forward yield, which projects into the future. Trailing yield can be super misleading. Also keep in mind things like REITs, real estate investment trusts. They're a special case. They naturally have really high yields because they're legally forced to pay out most of their taxable income. Now on the flip side of the coin, we have the dividend payout ratio. This is the company's view. It's essentially their profit-sharing metric, telling us exactly how much of their actual earnings per share are being handed right back to investors.
Check out this quote from the Hartford Fund's research on the screen. The best way to measure whether a company will be able to pay a consistent dividend is through the payout ratio. I love this because yield tells you what you get today, but the payout ratio tells you what the company can actually afford tomorrow. And if you really want to get technical, the smartest investors also look at the free cash flow, or FCF, coverage ratio. Look, earnings on an income statement can sometimes be, let's just say, manipulated by clever accounting. But cold hard cash? You can't fake that. The FCF coverage ratio is a way stricter test to see if a company can truly afford its payout. And man, this data brilliantly illustrates why that balance is so crucial. If you look at dividend-paying stocks broken into quintiles, check out the first quintile. These are the absolute highest yielders in the entire market. Notice how they're running an average payout ratio of 72%? They are stretching themselves incredibly thin. But then look at the second quintile. These are stocks with slightly lower, more modest yields, but they maintain a super sustainable 49% average payout ratio. And guess what? Historically, over multiple decades, that second group totally crushes the first group. Why? Because their payouts are actually sustainable, leaving enough cash in the bank to grow the underlying business. All right, Section 3, the dividend royalty. You guys hear these terms thrown around all the time, so let's lock down the definitions. A dividend aristocrat is an S&P 500 company that has continuously increased its dividend payout every single year for at least 25 consecutive years. Now, a dividend king, that takes it to an entirely different level, increasing dividends for 50+ years, half a century. You'll also hear broader terms like dividend champions, contenders, and challengers for different streak lengths. But hey, massive word of caution here. Watch out for survivorship bias. These lists are literally just a highlight reel of the companies that survived and thrived. They completely ignore the hundreds of companies that tried and totally failed to maintain their streaks over those same decades.
So let's look at some concrete examples of these kings, because the economic moats here are just wild. You've got automatic data processing, ADP, with a 51-year streak fueled by super sticky recurring payroll revenue. Genuine Parts is sitting on a 69-year streak, just riding that relentless demand for vehicle maintenance. Pepsi targets a payout ratio around 70%, while S&P Global plays it super conservative, maintaining a 20 to 30% payout ratio backed by massive free cash flow. These companies can pull off 50-year streaks because they have insane pricing power and non-cyclical demand. But here's the catch. Achieving that kind of longevity means these lists are heavily skewed toward non-cyclical sectors. Consumer staples, industrials, utilities. That introduces a ton of sector concentration risk if you aren't careful. Oh, and if you start looking at international dividend royalty, don't forget you've got to factor in currency risk too.
Moving on to Section 4, the compounding power of DRIP.
When you're holding these incredibly reliable companies, you get to unlock the strategic magic of a dividend reinvestment plan, or DRIP. It's so simple but so powerful. Step 1, you receive your cash dividend. Step 2, your broker automatically takes that cash and buys more shares, even fractional ones, usually with 0 commission fees. Step 3, well, because you now own more shares, your next dividend payment is going to be even larger. It sets off this amazing compounding cycle. Now, it's worth taking a quick second to contrast this with share buybacks, which is the other side of the whole capital allocation debate. While dividends hand you taxable cash that you actively reinvest via DRIP, share buybacks kind of invisibly boost your ownership stake by just shrinking the total number of shares out there on the market, and they do it without triggering an immediate taxable event for you. So both drive value, just using totally different mechanics.
And finally, Section 5, avoiding the yield trap.
Let's loop right back to that opening question. Is a massive yield always a good thing? Honestly, most of the time, it's a massive, glaring red flag, what we call a yield trap. Remember, yield is just the dividend divided by the share price. So an unusually high headline yield is very often caused by a stock price that is absolutely plummeting. It's signaling deep corporate distress. Basically, it's an advance warning of an impending dividend cut, not a bargain. And please remember, a long history absolutely does not guarantee safety. I mean, we've all seen falling kings and fallen aristocrats, right? Think General Electric or AT&T. A multi-decade streak does not equal future safety if the underlying fundamentals start to fall apart.
Which really brings us to the ultimate debate, the dividend-only focus versus the total return focus. Look, a dividend-only strategy is absolutely brilliant for income investors, retirees, or really anyone with a low volatility preference who just needs that steady cash flow. But it often really doesn't suit younger, growth-focused investors. Plus, if you're doing this in a highly tax-sensitive taxable account, those forced dividend distributions are going to create a constant tax drag. For those investors, taking a total return approach, balancing current income with the underlying capital appreciation of the stock, is mathematically just way more powerful over a long time horizon.
So, as we wrap up this explainer, I want to leave you with something to really chew on. Knowing that a stock price physically drops on the X date, knowing the real dangers of the yield trap, the reality of fallen kings, and the sheer compounding power of a DRIP, how do dividends truly fit into your long-term strategy? Are you just blindly chasing yield today, or are you strategically building sustainable wealth for tomorrow? Take a good, hard look at your own portfolio. What are your payout and free cash flow ratios actually telling you? Thank you so much for hanging out with me on this explainer. Keep learning, keep digging into those numbers, and I'll catch you next time.